Something unusual is happening in the gold market right now. And it's not coming from inflation data, it's not coming from the Federal Reserve, and it's not coming from Wall Street, it's coming from Russia. Because almost overnight, Moscow has moved to tighten control over gold leaving the country. And when one of the world's largest gold producers suddenly starts restricting exports, markets usually assume something bigger is going on behind the scenes. So the real question is simple. Why now? And what does Russia know that the rest of the market might be missing? On March 25th, Russia signed a new decree that will restrict the export of physical gold. Starting May 1st, gold bars weighing more than 100 grams will require special government authorization before they can leave the country. That might not sound like much. But here's the key detail. The standard gold bar used in global bullion markets weighs 1 kilogram. That's 10 times larger than the allowed export limit. So in practical terms, this rule effectively blocks most private gold exports unless the Russian government approves them. Individuals can't easily move bullion abroad. Companies can't freely export it. And traders can't quietly ship it out through normal channels. In other words, Russia just tightened the gate on its gold supply. And that matters because Russia isn't a small player in the gold market, not even close. Russia produces more than 300 metric tons of gold every year. That makes it one of the largest gold producers on the planet, second only to China in annual mining output. Roughly 1 out of every 10 ounces of gold mined globally comes from Russia. Think about that for a second. If a country responsible for about 10% of global gold production suddenly starts controlling where its gold goes, that has the potential to ripple across the entire bullion market. But production alone doesn't explain the timing. To understand this move, you have to look at something governments worry about far more than commodity markets: money leaving the country. When governments tighten controls over gold exports, it's usually about one thing: capital flight. During times of financial pressure, wealthy individuals and companies often look for ways to move money out of the country. Bank transfers can be monitored. Currency exchanges can be restricted. But gold is portable. It's private. And for thousands of years, it has been one of the simplest ways to move wealth across borders. A handful of gold bars can represent millions of dollars. And unlike digital money, physical bullion doesn't need a banking system to travel. So if people inside a country are worried about economic instability, sanctions, or currency risk, gold becomes an obvious escape route. Russian officials have openly said the new restrictions are meant to reduce capital outflows and limit activity in the shadow economy. In other words, the government doesn't want large amounts of wealth quietly leaving the country in the form of gold. But that's only part of the story. There's another factor here that may matter even more. Back in 2022, something happened that changed how many governments think about financial security. After Russia invaded Ukraine, Western countries froze roughly $300 billion of Russia's foreign reserves. Those reserves were held in foreign financial institutions, and almost overnight, they became inaccessible. That moment sent a shock through the global financial system, because it showed something very clearly. Assets held inside the Western financial system can be frozen. Gold held inside your own country cannot. Physical gold stored domestically is outside the reach of foreign sanctions, and Russia has spent years preparing for exactly that reality. Over the past decade, the Russian central bank dramatically increased its gold holdings while reducing exposure to U.S. Treasury securities. The message was clear. If geopolitical tensions escalate, gold becomes financial insurance. So if gold is becoming part of Russia's strategic financial defense, the last thing the government wants is large amounts of it quietly leaving the country. Which makes the export restriction look less like a technical rule and more like a strategic decision. Now here's where things get interesting for the global gold market. Russia produces more than 300 tons of gold per year. If a large portion of that production stops flowing freely into international markets, it could gradually tighten physical supply. Gold prices are heavily influenced by futures markets, interest rates, and the US dollar. But physical supply still matters, especially during periods when investor demand is rising. If Russian gold becomes harder to access internationally, refiners and bullion dealers may eventually have to source more metal from other regions. That doesn't necessarily cause immediate price spikes, but over time, tighter physical supply can create what traders sometimes call a scarcity premium, where the physical metal becomes harder to obtain than the paper market implies. And when that happens, price dynamics can shift. But Russia's move may also reflect something larger happening in the global financial system. For decades, gold was treated mostly like a commodity, a hedge, a portfolio diversifier. But recently, governments have started treating gold more like a strategic reserve asset again. Central banks have been buying gold at record levels. Countries facing geopolitical tensions are particularly interested in holding assets that cannot be frozen or controlled by foreign governments. Gold fits that description perfectly, and Russia appears to be leaning deeper into that strategy. Lock down domestic supply, control exports, and keep more gold inside the national financial system. So what happens next? That's the part markets are still trying to figure out. If this policy remains a temporary capital control, the global impact may be limited. But if Russia begins systematically keeping more of its gold production inside the country, the global bullion market could gradually tighten, because the world would effectively lose access to a significant portion of Russian supply. And that's where things could get interesting. Gold has always been more than just a commodity. It's money, it's insurance. And in times of geopolitical tension, it becomes something even more important, a financial asset that sits outside the global banking system. Russia seems to understand that, which raises an uncomfortable question for the rest of the world. If more countries start locking down their gold the way Russia just did, what happens to the global gold market?